Howdy y'all. Welcome to the World This Week by Wah for the week ending October 5th, 2008. Started out there with a little reflection in my eye of my doorway for a beautiful day. We've got a few things to talk about this week, so I won't screw around. I'll just go ahead and get to it. We're going to talk about the economic collapse. What was done, what was didn't done, why things weren't done, and what finally happened. We're also going to give my explanation of why the whole thing happened. I actually know quite a bit about this. I'll go into that in a minute. Two, we're going to have a big update on the presidential debate from a couple weeks ago. Some pre-debate stuff, what actually happened in the debate, and some post-debate analysis. And then, of course, the Palin VP update, which will be fun, because that's a big joke that's getting bigger and funnier as we go along. A couple of stories on gaming and some media. Updates for the wars that we're fighting right now in Iraq and Afghanistan. Fun to talk about how we're winning them. Let's find out what's going on. Talk about the economic collapse of the U.S. and how this happened. I want to talk real quick because I think you need to understand how it happened to understand how we can try and keep it from happening again. This did happen actually before in 1929 when the U.S. economy, everything all kind of disappeared and all the wealth disappeared and all the banks at once. What they built after that was basically a wall that went between two major kinds of wealth. One of those kinds of wealth is the wealth of your home, your mortgage, your savings, real money, tangible assets. The other part of wealth that we have is investment income, stuff where you're saying, okay, here's some money, go make me some more money with it. These tend to have better returns but are more risky, and these are more long-term, real kind of stuff. What happened in 1929, they'd all been mixed together, and so they all crashed together. So they built a wall with the Glass-Steagall Act. Now, the reason that comes up is because that wall was removed in 1999 by Phil Gramm and Congress, and President Clinton signed it. He would have been overrode, but he supported it anyway. Now, the thing about this is, and I'm going to explain how our stock, the real estate bubble came about and then who popped it. This is a very similar thing that happened. Clinton signed it, but it was under somebody else's watch that this happened, which is, Bush, who's been the president for the last 8 years. The similarities in what happened here and what happened with Enron are very incredible. I mean, it's the same kind of thing where you basically had an unregulated market with a new thing that hadn't been allowed before, that nobody was watching. And the way it works is this. I'll put up the graphics for it later. Essentially, right here you have now, and here we're going to have flowing time. So it's always now right here, and time continues to flow. Out here you have the market. This is the futures market that they talked about. For Enron, it was all sorts of futures, energy stuff, and whatnot. In the case that we're talking about now, it was a lot of mortgages and your regular stocks and whatnot. So what happened is they let the market get so far out here and so abstracted, and so much money got pumped into this that the speculation of it, and it got so far away from what was happening now that the thing broke and it all crashed to bits. Now, the solution, of course, is A, to keep this from getting too far abstracted and letting people get too creative, and also to keep that line that we used to have between the different kinds of wealth in our country. Now, what happened when you allowed those two to mix, and let me say, I know this, I spent a number of years as a professional consultant for large companies doing financial analysis. I've did some bankruptcy analysis, actually on Enron, and also have worked with a number of companies. I actually worked for the FDIC for a while. I've actually closed banks. I know when they talk about how they're putting these loans together and reselling them, how that actually happens. I have done a lot of data analysis in my time, and I'm pretty good at figuring out what's going on with this, because I actually have to figure out how to explain it, not with words, but with data and math and logic. Build databases, put data into them, and analyze it, and then say what that data means. So you kind of have to understand every aspect of it in order to do that accurately, and I was pretty good at it. So what happened when they took away the wall between the two kinds of wealth is it made a lot of credit available to a lot of people. So it was a lot easier to get a lot of money for credit. Now, because this credit could then be backed and traded as a security, they would put all these mortgages that people would out and then sell them like stocks, so they become like a revenue generating thing where people pay their mortgages and that money basically gets passed out. It's like a company making money. Now, because there was so much credit coming in, the prices for these mortgages went way up. This is what the bubble was. This was the money flowing in because there was more money available, because people could now pull out their equity and then invest it and switch it around. So there was all this more money. What had been two markets of wealth all became one. So the stock market went up because you now have these mortgage-backed monies that you could then put into it, and the equity that already existed could be used and put into the same market. So it all came into the same market. So which pushed prices way up, had this abstracted thing and this huge bubble. Now this bubble got sucked stuff out of huge. The Glass-Steagall Act got pushed back in 1999 by Phil Gramm, like I said, and Clinton in the Republican Congress. Now, from 2000 to 2008, Wall Street, all these Wall Street firms that are now failing, passed out, let me make sure I got this right, from 2000 to 2006, sorry, this doesn't even include the last couple of years, over $121 billion in bonuses. That's a lot of money to pass out because that was what they were doing. They would take these mortgages. Now, here's the other thing about these, why they were so difficult to value. Now with the stock, you have like a PE ratio. You have how much money the company is bringing in and basically how much the stock price costs. In the case of these mortgages, you had stuff like these high-risk mortgages, the subprime market. Now in order to give a subprime mortgage, you charge a higher rate. So you have a big loan, because there were these inflated prices, at a higher rate. Now a big loan, high rate, equals big money. Now those kind of loans look like they're going to be worth a ton of money, so they look like they have a great deal of value. However, when you start to figure in defaults, you have something, basically it's like a company could have great earnings, which is to say the mortgage gets paid off, or it could go bankrupt, and the mortgage you get nothing but what's there. And you have to pay all these costs to transfer it over and trade out the value. So you have an option of this mortgage, a subprime mortgage, with this adjustable rate, either being worth a ton of money or worth crap. And it turns out a lot of them are worth crap. Now the way the market works, it's something that is worth something. As something that is like that thing begins to lose value, that other thing that is like it loses value. So the value of all these subprime mortgages, as people start to default, pulls down the whole thing. So it pulls down all of these, so what used to look like it could have been worth a bunch, now looks like it's not probably going to be worth much. And as you continue to go over time, is going to continue to crash. So what all these banks, both kinds, had to now do was write down all these really bad loans that the people on Wall Street had made a ton of money reselling and speculating on. Exactly like what happened with Enron, and under the exact same person, George W. Bush. So that's basically what's happened now and how it crashed out. I had a little funny thing on here. There's a letter from Henry Paulson. Let me see if I can read this to you. It says, "Dear Americans, I need to ask you to support an urgent secret business relationship with a transfer of funds of great magnitude. I am the Ministry of the Treasury of the Republic of America. My country has had a crisis that has caused the need for a large transfer of funds of $800 billion US. If you would assist me in this matter, it would be most profitable to you." Basically, somebody put together one of the Nigerian 411 scam letters for Paulson's proposal. This original proposal did not go so well. One, because it was not big enough, I guess, and two, because people were a little bit panicked about reacting to it. We'll get to what happened and exactly why in a second. I want to go over real quick, though, something, if you're pissed off at Wall Street, how to fix it. And it's pretty simple. I had this actually discussion with my mother because we were talking about it. And, she's like, "Well, I'm just mad that all these people out there made so much money and now they, getting away with it." Yeah, you want to not let them get away with it? Vote for Obama, because his tax plan is going to raise their taxes for the people who have that much money and made that much money and continue to make that kind of money. Yeah, billions. They made billions, $120 billion. The average bonus for these years is in the hundreds of thousands of dollars, which puts them in the tax bracket of people who will have to pay more under Obama to pay for all their problems. So hey, look, the people who cause the problems get to pay for them. What a concept, huh?